Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, UK rate strategist, and I'm joined today by our global market specialists, Giles Gale and Jan Nevruzi. Okay, I told you all last week it wouldn't be long before the UK is demoted from the top spot. So let's kick things off today with Europe. We're recording this on Thursday, so fresh off the ECB. Giles, I hope you've had enough time to gather your thoughts because I have lots of questions. But let's start, let's start with the kind of rate decision. That's, I guess, the first headline that we saw today. So they hiked as expected. What are your thoughts around that? And I suppose guidance around where rates are headed in the future?
Yeah, you're not wrong. I haven't entirely gathered all my thoughts. I've got a bit of a beehive. So on rates specifically, clearly the 75 basis points was absolutely as expected. No surprises whatsoever there. The tone, though, was a lot more dovish, I think, than people had been anticipating. Last time around in September, for example, they had in their statement this idea that they had several rate hikes still to come, and that went. They also talked about the rate hike as what was needed in the context of very accommodative monetary policy. That all went as well. Okay, so now we're at 1.5%, and essentially what they're saying is from here, data dependent. That was something that was repeated by Madame Lagarde. But also, I think we should be inferring more gradual. And I think that a reasonable base case is probably now 25 basis point moves at upcoming meetings. That's not to say that 50 basis points in December isn't absolutely possible at this point, but I think that you're probably looking at a higher likelihood of a 25 basis point move. Now, they could have a string of 25 basis point moves, depending on how things go, but this global, whatever you want to call it, pivot is the word that's often used, but that's not the right word, I would say. But this global kind of slowdown is, the ECB is definitely now part of that.
Okay, so when you talk about a string, how many in your kind of reasonable base case of how many 25 basis point hikes are you thinking about, and where does that take terminal rate or peak rates in this cycle to, do you think?
Well, I think that 2.25 is probably a reasonable guess. I could see 2. I could see 2.5, but I think that your range for that sort of terminal rate is starting to shrink a little bit, and it's starting to center more in the low 2s rather than the high 2s.
And is it fair to say then that your assessment of that peak or terminal hasn't changed that much, but perhaps we just get there in more gradual increments after today? Or do you think it has kind of lowered it by 25-ish basis points, let's say?
I think we've always been reasonably consistent that when we were pushing 3%, that was likely to turn out to be too high. In recent Bondcasts and sort of discussions with clients and so on, we've been talking about 2.5, 2.75 as maybe a better guess. So I think, yes, I am bringing my sort of base case expectation down a little bit, partly just in line with the week data, partly as well because the bank lending survey this week was actually really pointing to some concerning developments in financial conditions, which I think was alluded to by Ms. Lagarde today when she was talking about the need to be attentive to the way that monetary policy acts with a lag. That's a very clear way of saying, listen, it's not about this overriding need to close the gap. We're not on this catch-up phase anymore where we're just trying to close the gap. We are actually worried about what the total impact of what we've already done is, and we need to be a little bit more conscious of the fact that what we continue to do will not actually have an impact on the real economy for quarters to come. Okay, so that's all being reflected in there. I think this idea that they were just going to get all the way to a restrictive policy level and then stop and maybe even start cutting rates, that's being revealed as well, clearly not the strategy at this point. So I think that 2.25 is a reasonable central case, perhaps 2.5.
And so moving on, well, sort of moving on a little bit from rates, I suppose, the other, I guess, a bit more discussed part of today's meeting, or certainly discussed as we are fresh off the meeting, is around TLTROs and the changes that they've made to the rates that banks earn on that TLTRO cash. Can you kind of talk us through those, and I guess more importantly than just the changes they've made, what they really mean for markets and how you expect markets to react to that as perhaps more of this TLTRO cash is repaid back, if that's what you expect?
So basically what they've done is they've changed the terms on the TLTRO so that from the 22nd, I think it is, of November, the rate which is the effective rate on TLTROs in the sense of the cost of continuing to borrow the money from the ECB every day will be aligned with the deposit facility rate. So all those banks that were borrowing money from the ECB at this low TLTRO rate and then just putting it straight back with the ECB in order to make a riskless, effortless profit will no longer be able to make any money from that. They won't be penalized if they want to continue to do that, but they won't make any money from it. And so any bank that's doing that will be thinking, okay, well, first of all, it's a bit of a balance sheet problem. There's also the question of contributions to the Single Resolution Fund at the end of the year, which all of these things push in the direction of repaying the TLTROs. So base case, your banks in Germany, France, especially Benelux, all these guys that really were just in the TLTRO, or mostly in the TLTRO, for this kind of riskless profit, will probably be repaying. So I'm guessing at this point that we're looking at repayment before the end of the year in the order of €1 trillion. Okay, so what the markets really care about here is how much collateral and of what quality that will bring back into the market, because there's this whole, in parallel with this discussion, there's been this question about what the ECB might have to do in order to ease this collateral shortage. And so the first answer is, well, encourage TLTRO repayments, get the collateral that was backing that borrowing back into the market, and then see where you are, I suppose. So what we really care about here is Bund collateral, above all. And the most likely banks to be posting that are obviously German banks. German banks took about 400 billion, or they still have about 400 billion outstanding borrowing in the TLTROs. I expect that almost all of that will be paid back. So the question is, of that, how much of that will actually be Bund collateral, which comes back? And my suspicion is not very much. I mean, the average across the euro area for central government securities is about 1/6 of the total of the total in the mix of the collateral that's placed with the ECB. So that would suggest maybe 60 billion or something like that of that 400 billion for German banks. But in practice, I don't think the German banks probably were using Bunds, especially because it's high quality collateral. They can use it for lots of other things. They can, amongst other things, they can use it to borrow uncollateralized at a pretty decent, borrow collateralized at a very attractive rate anyway. So rough guess, maybe 20 billion, 30 billion, something like that may come back. It's not game-changing, I don't think. At the margins, it helps. But I think that there was such enthusiasm and excitement about possible other things that the ECB might be able to introduce in this meeting to alleviate this collateral shortage, that actually we've probably been confronted with a bit of a disappointment.
So I guess that's the obvious follow-on question then that you sort of half answered, but if it's not game changing, is it really enough to ease this collateral scarcity? And if not, what's the next step, and when do you expect that? There's been a lot of discussion this week, like you say, around other options that could be on the table. It felt like this week perhaps wasn't the moment or even it was too late by the time a lot of these discussions were happening this week for it to be a kind of this meeting problem. But what else could the ECB do, or what else do you expect them to do, and when?
Well, I think everybody knows what they could do. They could do something like the Fed's RRP, and so borrow back money from the banking system in exchange for securities, so via repo operations, or they could sell bills, something like that to sort of set a floor level for money market rates. There was a lot of noise coming into the meeting about these possibilities. To be fair, all of it coming from outside the ECB. I haven't heard any ECB speakers that you would really pay attention to talking about this as a serious possibility, but it's clearly there in the debate. I'm sure it will reach the governing council inbox at some point. And I think that they are quite big steps, and I think that there things like the RRP, they're probably too difficult. I think that the Bill's idea is, it also has its complications. In particular, I think that just the possibility of creating something that the market's going to get addicted to is something that they'll resist. So I don't really expect these to come, but I think that it's something that we will probably come back to in future Bondcasts.
So I guess anyone who listened to the pod last week will know that is 2 out of 3 of the major things that we were looking for from this week's meeting. And the third was around quantitative tightening. We were thinking that maybe they could give more detail around any kind of balance sheet shrink that they might be planning to do in the years ahead. Did we get what we were looking for there?
Well, not exactly. I actually thought that they might make an announcement this month. I still think that the timing would have been at least justifiable, but no, in fact, I think it probably would have been pretty good timing compared, for example, with making any announcements in December. What we were told was that they will tell us that they will have deliberations in December, and they will tell us about their intention. So, essentially, what the strategy will be. So that doesn't mean that we're expecting an announcement, but I think it will help us to understand whether we should expect quantitative tightening to start in the first quarter or the second quarter next year. I think still reasonable base case is that this is a first quarter 2023 kind of issue. Maybe just one last point. I think another interesting thing that might be on the table for December, towards the end of the press conference, Lagarde made this kind of tantalizing statement that they were watching the year-end turn very closely. Not just closely, but very closely. And then she just kind of left that one floating there. And it was like, I suppose, maybe too late for anyone to pick up on it in subsequent questions. Obviously that points in the direction as well of some kind of facility to try to floor money market rates over these stress points. So still, there's going to be a lot of work between now and December, and the December meeting is going to be interesting too.
Great. No quiet Christmas for us then. Well, for you, I'll have a quiet Christmas. Probably not in this market. Okay, right. Let's move over to the US then. This kind of pivot discussion, Giles, you already alluded to it, but that's been, I would say, driving global fixed income markets to an extent this week. We obviously have the Fed next week. What's your take, Jan? Is the pivot on? Is the pivot even the right word, or are we all just getting a bit ahead of ourselves here?
Yeah, I think it's key when you ask the question, is pivot the right word? Because some people necessarily think that pivot has to mean the Fed is cutting rates or completely turning around. Others interpret it as more so, well, if you step down from 75 into 50, is that a pivot? I'd say no. I mean, that was a clearly signal. That being said, we don't think they're going to step down at all this month. Next week's meeting, we're looking for another 75 basis point hike. But it's kind of that article in the Wall Street Journal alluded, and we also had seen in the minutes as well from the September meeting, the Fed will discuss at some point whether they will slow down the pace, go from 75 to 50. I mean, in historical context, it's still a really, really accelerated pace of tightening. So it's not like they're entirely, saying we're done here. They're just I guess, slowing the pace of tightening, which was going to happen at some point. It was inevitable, and that might be in December, but and that's our call too. But that being said, I don't think it's a sure thing that they're going to slow down. By the time this is released, we will get the employment cost index data. That's tomorrow morning. So if the ECI is soft and shows wage pressures in Q3 were more moderated, maybe, it kind of increases the odds of slowing down again. But if it shows that wage pressures have been fairly robust, I mean, maybe they stick to 75 again and maintain this front-loading approach. But for markets, and markets have taken the pivot idea, and that's one of the things that I was talking recently with a colleague, that markets sure love a good pivot narrative, even if it doesn't happen. We had the same thing in June when we saw kind of this like rally following that, and yields have like one handle higher than they did back then, at least in the US. So it's not going to be that eventful. I would think that Powell wouldn't want to lock himself in a position where he says, oh, we're going down to 50. Why do it? There's no upside in saying we might slow down the pace of tightening, and there's no upside to committing in anything. And I think they probably learned their lesson from doing that in the past. So you never know, you get another strong CPI print and we're off to the races again. But it should be a less eventful meeting because we're not getting the economic projections, and we're just going to get the hike that's priced into the market most likely, and not too much commitment for the December meeting. One thing that could change perhaps in the language, that they used to describe the job market as robust. Maybe they change that to strong now to reflect a slight moderation in job gains, but even that's it's kind of like a toss-up.
Okay, so obviously, that like every other central bank, they've emphasized how data dependent they are, and you agree that that's going to be what forces their hand. We had GDP data this week. What's your take on that, and what that really means for the Fed going forwards?
So the GDP data on the headline number for the third quarter was a little bit better than expected on the headline. It came at 2.6%. Versus 2.4 expected. But once you look down a little bit under the hood, it wasn't as strong, I would say, because, well, three main things. For one, net exports were a massive boost. So they provided, out of the 2.6% gain in GDP in annualized terms, 2.8 of that was due to net exports. So the US significantly decreased the rate of imports while increasing exports. So that also petroleum products, some of them things like computers and more like high-tech durable goods. So those did provide some boost, and it wasn't anything like agriculture, but mostly like petroleum. But is that sustainable? I don't know. Because of what's going on in the world, it is understandable that there were probably almost forced buyers of U.S. commodities. So that makes sense. But on the other hand, the dollar is fairly strong. It still remains very strong. So the imports, the drop in imports is also kind of understandable. But the export part is, and the other reason I would say it's not really sustainable at this pace is global aggregate demand is slowing down, and exports are going to be a reflection of that too at some point. So if it wasn't for exports of externally driven demand, GDP would not be nearly as strong. Of course, I can't start stripping every component because at that point we fall down to zero once there's nothing left in there. But exports were very strong. The second point I'd like to make is goods consumption continues to fall, but services is still fairly okay. Americans are spending on kind of more like service-related sectors and less so on durable goods. And finally, capital formation, so like fixed investment, did show a decline again, but that's almost all explained by the absolute collapse in residential investment. So we've seen a lot of that in headlines as well. You see weekly mortgage applications, home sales, they're all falling. So with that, of course, we did expect a drop in residential investment. Of course, the magnitude of that is super hard to forecast. It was 26% for Q3 on an analyzed rate. So you can see it's a massive drop. But that being said, business investment, so like non-residential investment, moved higher. So CapEx isn't entirely falling off a cliff quite yet. So under the hood of the GDP number, it was not as strong. It was almost like a reversal of the first and second quarter, where we had a stronger consumer but weaker inventories, weaker exports, and that led to negative GDP prints. This is almost entirely flipped. We have strong exports, but weakening consumer and weakening investment. So we still think the economy is going to slow down and go into Q4, potentially enter a recession early next year, end of this year. But this should give some cover to the Fed and to, to the, I guess, administration to say, hey, look, the economy is still growing robustly, and especially if it's combined with a deceleration in inflation, it should be good news for the Fed.
Okay, so Imogen, over to you on the UK now. So we have a new Prime Minister, and we have delayed the October 31st budget to, I think, the 17th of November, which is incredibly inconsiderate because that really plays havoc with our scheduling. I think they should have consulted. But nonetheless, why have they done that? And how does it change what you're expecting for that event?
Yeah, I think when it comes to the UK, we need to start recording these pods so frequently because it feels like ages ago that we had a new Prime Minister. But you are right that we haven't recorded a pod in that time. Well, yeah, that no one needs me to tell them that Rishi Sunak is now the Prime Minister of the UK, and his decision was, like you say, to delay the budget that we were expecting on Monday, the 31st, now to the 17th of November. There were kind of mutterings early on that this might be delayed, but that seems like a fairly lengthy delay versus what was kind of being leaked into the press in the days before it was announced. I think there's a couple of reasons that has been delayed so far. The first is that it gives the new government time to, I guess, prepare and also kind of get support for any spending cuts that might be delivered in the budget. You know, the message from the previous mini budget that caused the market reaction, the new message was now that this government was going to deliver on spending cuts, and tax cuts were at least going to be delayed. And therefore this gives them time to work through exactly what those spending cuts are going to be, and time to kind of sell them back to their own party, if you like. The second point is that, and importantly for markets, I think, because this is the risk that we were thinking about with the budget being delivered on Monday, it gives them time to fully prepare what the energy support package beyond April will look like. And the more details that they are able to have on that, the better it becomes from a OBR projection perspective, because there's more certainty around what the kind of fiscal trajectory is over at least the next 18 months, let's say. And the third reason, I suppose, is a little bit more cynical, but it just gives the OBR the chance to use slightly more favorable interest rate projections in its fiscal forecasts, given that clearly if they were delivering a budget on Monday, the kind of baseline yields that the OBR will have had feeding into its forecast would be considerably higher than if interest rates remain at, or yields remain at these kind of levels, than the inputs that they would have in in 2 weeks' time. So there's a couple of reasons that it was delayed that seem to make sense, I suppose. But from a market's perspective, I'm not sure that it matters all that much, to the extent that it's been delayed so that the government can deliver bigger spending cuts. Obviously, from a kind of, supply yield perspective, that might suggest that you would think that supply might be lower and therefore yields lower. But then to the extent that it probably also guarantees that you are going to get more detail around the costings of any energy package beyond April, that then kind of increases what your supply projection might have been versus the baseline. So overall, I'm not sure that it kind of materially alters what you might have already been thinking about the numbers that would have been delivered ultimately in the end anyway. So where does that leave us? I mean, we, listeners of the pod will know that we think that the market has perhaps overestimated what the government's U-turn and the change in policy over the last couple of weeks means for the supply outlook. We still have a materially increased number for gross gilt supply, this fiscal year, but more importantly, next fiscal year. We see that number rising to close to 300 billion gross gilts, which, once you're offsetting Bank of England demand as well, is really quite significant and does mark a regime shift in gilt supply. Now, there's obviously question marks around that number. For anyone that's interested in the numbers themselves, we've baked in 50 billion in terms of costing for the energy support package. Now, we don't have any color really on how generous or otherwise, or how targeted or otherwise that energy support package is going to be. So 50 billion is a guesstimate, I would say, based on this idea that it's going to be bigger than zero, and the price cap that's in place at the moment was estimated to cost 60 billion for half a year, so 120 billion for the full year, and so 50 billion seems like a reasonable sort of midpoint, if you like, within that range. It obviously could come lower, it might come higher, and again, if it's a kind of price cap design mechanism, then it depends on what happens in wholesale energy prices as well. So we recognize that there's probably a larger kind of ranges of uncertainty than usual around these forecasts, but based on what we think is a reasonable estimate for the measures that we're expecting to be announced, it still constitutes a fairly sizable increase in supply, both for this fiscal year and next. So I understand why the market has moved the way that it has, but I think this idea that supply isn't going to increase materially just because we've had a change in government and a U-turn on some tax policies is the wrong reaction.
Okay, so I mean, in particular, the or decisions about how the price cap might look could have been very useful information for the Bank of England, who will be meeting next week in advance of this fiscal announcement, rather than having had a few days to digest it. So does that change anything for them, do you think?
I mean, I'm sure they're not super thrilled about the idea that they're making another policy rate decision kind of immediately before a major, what might be what the markets will see as a major fiscal announcement. Does it change what we think they do? No, I think that we were already slightly more dovish than market expectations, which have moved towards our base case of a 75 basis point hike next week. Now, if you recall back in August, I think we discussed this last week, or we have definitely discussed it recently on the pod, and they, MPC members have openly come out and said that given that they didn't have the kind of sufficient information around the fiscal policy over the coming months and years that fed into their macroeconomic projections, it was difficult for them to kind of place much weight on the projections when it came to them being a sort of guiding principle for monetary policy over the next couple of months and years. So back in August, which was when we last got their updated forecast around, they almost did away with those projections, and even though they were showing inflation well below their target over the kind of end point of their forecasting horizon, they were still plowing ahead with bigger than they had been doing hikes, and also fairly hawkish rhetoric, because they appeared to be kind of more spooked by spot inflation today than they were about the growth outlook. So at the margin, maybe you think it risks another reaction kind of like that they just become more reactive to inflation today versus what their medium-term projections are telling them, because their medium-term projections won't be that well informed. Now, I'm sure that they will be having discussions with the Treasury and potentially even with the OBR around what these projections are going to show, but they can't make monetary policy decisions on fiscal policy that hasn't yet been announced. I think that our base case for 75 basis points is probably very close to consensus, and a bit like the ECB today is pretty much nailed on now. We think that that's delivered with a 7-2 vote, so fairly consensual across the MPC, and those two voters are descending in the dovish direction versus the hawkish direction. Again, I guess just to comment quickly on the forecast, these won't be perhaps regarded particularly heavily by the market, just given that they won't be fully informed by what's going on the fiscal side. But I do think that what's going to matter most for the forecasts over the kind of 2 to 3 year horizon is the revision up in bank rate expectations that we've had over the last couple of months. And that will weigh more heavily on their projections than say what's happened in FX and the depreciation of sterling. So we actually see a revision down to their inflation projections over the 2 to 3 year horizon. But like I say, given that they won't be fully informed by fiscal policy or the fiscal policy changes that we're expecting in the next couple of weeks, I think that they still react hawkishly or more hawkishly than they have been doing, and hike in bigger increments than we're used to. The only other thing that is probably worth mentioning that I don't expect any discussion on is around active sales, quantitative tightening. That's set to begin next week on Tuesday. It was initially on Tuesday to avoid clashing with the budget on Monday, but that's now not happening. So there's been a lot of rejigging in UK kind of DMO, BOE schedules over the last couple of weeks to avoid this fiscal event. But never mind. But the Bank of England have tried really hard to kind of disentangle decisions around quantitative tightening and active sales from monetary policy decisions. So actually, I don't expect much of a discussion at all around quantitative tightening next week. They've told us that they won't be making decisions on a meeting by meeting basis. They won't be changing the pace on a kind of meeting by meeting basis. And in any case, we will only have had, although it begins next week, we will only have had one auction. So it will be difficult for them to kind of read too much into any market reaction, going forwards from just one small auction of active sales. But I expect them just to confirm that, they expect active sales to continue through this quarter as per the schedule that they have laid out. And just in case anyone was wondering, I do expect them to include longs in next quarter, which we will find out about, I think, around mid-December when they release the schedule for the quarter ahead. I think that they will then revert back to the kind of original plans of selling equally across the curve, and that will include longs as well. Okay, that's enough on the UK, I think, because like I say, it certainly wasn't the driver of global markets this week. And we will return next week to discuss all things Bank of England and the Fed, and what European markets have done in the wake of this busy ECB meeting. Just a reminder to our listeners, if they liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks, see you next week.